Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Today, President Trump provided an update on ongoing trade negotiations, and he said that he signed a deal with China on Wednesday. Now, the president really didn't elaborate much, but later we got a few details from Commerce Secretary Howard Lutnick, who spoke earlier to Bloomberg's Balance of Power, and we'll bring you that conversation in a moment or two. But we begin with markets. Today, the S&P 500 flirted with an all-time high. Now, much of the focus was on a resumption of Fed rate cuts. We caught up earlier with the head of the San Francisco Fed, Mary Daly. She told us it doesn't look like tariffs will cause a big spike in inflation. And now she's open to cutting interest rates in the fall.
It's both sides of our mandate that have really come into frame since we brought inflation down from the really high levels to something that's closer to our target. Ultimately, we have to watch both sides, and that's what I'm doing. And then the fall looks promising for a rate cut.
That's Mary Daly there, head of the San Francisco Fed, speaking earlier to Bloomberg. Joining me now is Rebecca Walser. She is president at Walser Wealth Management, and she is here in our New York studio. Nice of you to drop by. It's great to see you as always.
Thank you. Thanks for having me.
There seems to be a lot of aggressive betting in the market right now that we're going to get maybe as many as three rate cuts this year. How are you feeling about what the Fed may deliver between now and, let's say, December?
Yeah, we just saw that today, actually, Doug, that the swaps market said maybe even a third today, which was a little bit unusual. Listen, in my opinion, I think Powell's hands and the board's hands are tied until we at least get past July 9, which is, the tariff kind of due date of getting these things resolved. We're getting alerts that Europe is really getting closer to some kind of, a tariff policy interchange with the Trump administration. And of course, then we have the China situation, which is, unfortunately not nearly as far along as it should be. It's not going to stop at the 55. That was just kind of a barometer trying to get to July. And obviously, they're not going to want tariffs anywhere near that. So to Chairman Powell's defense, he can't make policy in the absence of what's going to happen after July 9 or after we get at least some indication of how these tariff and trade deals are going to interact and play. And so from that perspective, I understand why they're basically such a small percentage, at least there was a small percentage of any kind of cut for the July meeting, which would then lead us obviously till September. If you think they're going to get three, Doug, and we don't start until September, that's going to make it really tight, because you're going to have September, October, November, December, and it's going to have to be almost a cut at every meeting. So that almost would indicate to me that there's systemic problems that would require three cuts. And I just don't see, because of the animosity, unfortunately, between President Trump and the Federal Reserve, at least with Powell, I don't see Powell trying to assist necessarily with that aggressive of cuts in the latter half of the year.
So he was already floating the idea of naming another Fed chairman even before Powell's term expires in 11 months from now.
Exactly.
I think it's fair to assume that whoever it is, they're going to be more dovish than Powell has been. Could this potentially create a problem?
I mean, I think the Supreme Court tried to dispel any kind of ambiguity with what authority President Trump had around the appointment or the removal of Powell by basically stating in an unsigned order that Powell was not removable. And so then you can see that Trump is reacting to that by stating, hey, let me rattle your cage by giving you maybe some nominees already. And I think that's not good for us. We need to be united.
If his successor is a dove, what could that do?
I mean, that's a good point. It's kind of similar to a lot of these CEOs and a lot of these countries hedging tariff policy and what they should do with their factories and their supply chains, because they're saying what's really going to happen in 4 years, right? So if you have a Trump naming a successor to Powell who is vastly different than Powell, then you are going to upset the markets, because they're going to know that whatever policy Powell puts in place is going to be probably immediately turned around 11 months from now.
So you were talking about tariff policy as it relates to July 9th. We're going to have this Commerce Department investigation on the basis of national security issues and whether or not there are going to be new tariffs on things like pharmaceuticals, semiconductors, certain metal products, maybe even steel remains an issue in terms of national security. We'll have to wait and see.
Yeah.
How are you feeling about how this could feed into the equity market?
Well, I think that it absolutely would boost any argument argument for tariffs. And I think that's because the American people just don't really have a great understanding, Doug, of how the coronavirus supply chain problem really happened with the biopharmaceutical products. We get a lot of our materials for our pharmaceuticals from China. And whether it's an intentional thing because of tariff policy, or if it's a pandemic thing because the shipping lanes are closed, whatever the case may be, our country cannot be beholden to Asia and specifically China for the health of our citizens. And I think when Americans understand how desperately dependent we are, then you are probably going to see, I think that the means to an end, tariffs in and of themselves are not good, but they're a means to an end. So if it's too cheap to make something over there, but it's costing you national security, then it might cost more over here, but then we have it on our shores and we don't have to worry about shipping, and we don't have to worry about all kinds of, wars, any kinds of things like those things.
Does it surprise you that the equity market is trading near record highs right now?
It's such a dichotomy. Even if you look at the University of Michigan consumer sentiment, right? It plunged 29% in the first 4 months. We don't usually get a plunge that fast, that aggressively without a recession following. It's always indicative in the last 79 years of the survey of some kind of recession following. So to get that at the first part of the year and then get these almost record highs, it is so mind-boggling. But really, Doug, what it is it's almost a bifurcation, right? You're seeing, well, we don't know where else to invest in the world. And I know a lot of money has left the United States. A lot of the hedge funds have transferred money out and gone to Europe and those things. But really what you saw at the beginning of the year was a lot of, negativity around this tariff policy. It's going to cost more. We don't have the growth going into this year to sustain these tariffs. And so the end of the day, investors return home and say, gosh, this is the best place to be, even though this has problems too. So it is really weird to see such a high market and know that consumers still are very tenuous at best about this economy.
So what are you telling clients when they ask, is there opportunity? Have you identified one corner of the market where there is?
I think that there's always opportunity right now. And you can say that with absolute confidence because we are at the beginning stages still of monetization of the fourth industrial revolution. So there is a ton of opportunity around AI, around robotics, around blockchain technology, and so crypto. So all of those things are in their infancy and have yet to be fully monetized, which means that there's a long runway for that. And that is not going to change no matter who is the administration, no matter what the tariff policy is, no matter what's going on. So that is an opportunity. Now it has yet to monetize, and that does. And so what happens if you think of .com, before it monetized, it did come back down and there's a massive pullback, .com crash. I'm not suggesting that we might have that because we do have NVIDIA. We do have a lot of applications. You can see, you can type text messages now. Your email now is focus versus all because it's got AI in there. So it's already been monetized, but not anywhere near to where we're going. So there is opportunity, but it'll be on the longer term if we get into any kind of global war escalation, Doug, and if these tariff policies really do become protectionist of the United States, where we have to really do and change up supply chains, then you're going to see global equity pullback.
You're not concerned about valuations? I think the NASDAQ 100 is around 31 times earnings right now.
I am 1,000% concerned about valuations, but this is not a Trump trend or even a recent trend. This trend goes back to 2008, 2009 global financial crisis, and really the United States changing from what I would say, whatever monetary policy you want to say we had before, to modern monetary theory. You can look at the stimulus between monetary and fiscal from 2009 and overlay that with the S&P 500, and you will see where the money went. So these valuations have been propped up massively since the global financial crisis.
What about opportunities offshore? Are you seeing any right now, particularly in Asia?
I mean, we think that there's a long-term runway in Asia, but it's too risky for us right now because of the fact that there's an animosity between Asia and the West right now, and it's
so
really
Asia ex-China. What about Japan, South Korea?
Sure, but then I would say you have to worry about Japanese, their debt problem. I mean, they obviously have the worst debt problem in the world, and so far using the carry trade, it's been okay for them. But if that unwinds at any time, like we saw August 5th of last year, then Japan's going to have a massive problem.
Is India a market that you like?
India, absolutely. And they have a lot of natural resources, and they absolutely have the population to sustain maybe new supply chains that move out of China over to India. So, I mean, and they have the capacity as far as intellectual property and their engineers. I mean, just an extremely smart population.
So if you think the market has got it wrong in pricing in aggressive Fed rate cuts, Does that mean that the bond market is over its skis to the point where you would avoid the bond market right now?
I mean, it's a little bit alarming to me how fast the 2-year, the 3-year, and even the 10-year has pulled back in just the last 10 days. And you have to say to yourself, what is this that's happening? Underline, you have to really look. I mean, Doug, I've come in here multiple times for the last year and a half and said, look, we have a global macroeconomic currency turnover that has begun away from the dollar. The de-dollarization, even of China, is so rapid and so fast that is the long-term concern, is that how are we as Americans going to escape ultimately this and yet still not be the sole superpower that has the total Forex currency reserves? Like, we never were 100%, but we were so much higher than we are now. So that's the bigger play, is what is macroeconomically globally going to be going on with currency? And do we even need a reserve currency anymore now that we can bi-directionally trade with central bank digital currencies?
Rebecca, thank you so much for joining us. Rebecca Walser there. She is the president at Walser Wealth Management, joining here in New York on the Daybreak Asia podcast.